For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about whether or not you should buy the dip or stay the course. And we'll talk about the fact that 2/3 of investors are worried that they'll outlive their assets. Also, we'll compare 6 investment choices and what they can offer you. And finally, a late start investment plan. It's never too late. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice come from Jake Floyd and Randy Floyd of Floyd Financial Group. I'll start off with you, Randy. How you doing today?
Doing very well, Jeff. Just happy to be here.
Yeah, me too. The last bastion of sanity here, Springfield, Missouri. And Jake, how are you doing today?
I'm doing great, Jeff. Thanks for asking.
Hope everybody else is having a great weekend. We appreciate you joining us each and every week here for Show Me the Money. Boy, we've ever got a lot to talk about on today's radio program. U.S. stock market is plummeting amid tariff mania. Should you buy the dip or stay the course? Now, the stock market did plummet, but we're getting some dips, and we're also getting some bounces that come back up. But still, a lot of people are wondering, when the market is down, should we be taking advantage of buying this dip? What's your opinion, first of all, on the volatility of the stock market, and then whether or not we should buy this dip?
So the answer to that question, like so many questions that we answer on here, is it depends. So this particular setup that we're going into here, starting next week, we're going to have a lot of earnings calls coming in from these companies. So as you can imagine, let's zoom out for a second, right? So we had talk of tariffs. People elected Donald Trump to put these tariffs in place to have America take its rightful place back atop the leaderboard, if you will, of countries out there. And in doing so, some people didn't realize that that meant that the market was going to have a little bit of a pause here. As things came down over the last few weeks, they came down a little too fast, so we had a little bounce and all that kind of thing. If you ask me, I'm not sure that the bottom is totally in here. However, stocks are so much cheaper than they were just 6 weeks ago. We need to pay attention to what's going on here for sure. The hard part to predict is that you basically have one man unilaterally deciding what's going to happen here. And if he changes his mind at any given moment, this thing can be off to the races or plummeting like a rock. I do think that the answer to the question of whether we should buy or not really lies in what is Trump really trying to accomplish. I think he's trying to accomplish 3 basic things. So number one, the one that everybody would probably agree on is that he wants to bring some manufacturing jobs back to the United States. The other 2 are a little bit more controversial. I personally believe that Donald Trump wants to lower interest rates as far as humanly possible so that he can refinance our enormous debt of $37 trillion. And then finally, the third thing he's trying to do is weaken the dollar against other currencies. Now, some people are like, whoa. Why would we want to weaken the dollar? So when you go on vacation, let's say, to Mexico, everybody knows it's cheaper to go to Mexico than it is to go to Hawaii, right? Like a lot cheaper.
Right.
And the reason for that is the exchange rate on the currency, or that's one of the reasons, the main reason. So it works the opposite way when other countries want to trade with us. They're like, why would I buy anything from the U.S.? The dollar is so insanely strong that my money goes half as far there as it does a lot of other places. And so in order to correct that and have more trade balance, we need our currency to weaken some. Now, there's a balance there. We don't want it to weaken too much, but for the last 2 years, the dollar has been just about as strong as it has ever been. And so going back the other way a little bit will help our trade with other countries and that kind of thing. And so those 3 things, jobs coming back, interest rates going down, and dollar weakening some. The only way you get those 3 things is tariffs. If you do other things, you might get 2 of those 3 things, but if you want all 3, the tariffs are the way to do it. And that's why Trump has said many times, tariff is the most beautiful word in the English language, and all that kind of thing. And so while I agree with 98% of what's going on, and the other 2% I might agree with, I just don't have enough information, right? I'm not the president. I'm not privy to everything that he's thinking. I do think that this may take longer than people are expecting to work its way through. So on the way down, there's always going to be these bounces and these rallies. In fact, some of the biggest rallies, the biggest single day moves are bounces from bottoms of previous downfalls. Back to the actual question, which is, do we buy the dip or do we stay the course? The answer is at some point we're going to want to buy the dip, but I'm not sure that day is today.
All right, so what you're saying is we have not seen the bottom just yet. Should we be concerned about the volatility of the market, the fact that it goes up and down like this? I guess it has to do with uncertainty. I mean, the market does not like uncertainty, and right now that's what we've got a lot of.
Well, I think, Jeff, one of the main things is the older you are and the closer you are to spending money from your investments, or if you're already in retirement and you're doing that, has a dramatic effect as to what you do, right? So if you're 25 to 40 or even maybe 50 years of age and you're funding your 401k and you're working and you're trying to get ahead, keep investing. I mean, because this will be a blip on the radar looking way back over your shoulder one day. If you are, like most of our clients, you're at or near or in retirement, you're now seeing why, the last few years we had the downturn in 2022, then 2023 was kind of a year to rebound and make all the money back that we went down in 2022. And then we made some pretty good money in 2024. And now we're seeing this with the new administration in. Now you know why we use some safer tools and some buffers, if you will, to help us to mitigate some of the downside as we are pulling money from our retirement portfolios. So we've had those tools working really in our favor and in our clients' favor during this time. I've been doing a lot of reviews here, as I always do, and we're looking at, in some cases, we're down half what the market is in some cases, depending on the client's risk, what their risk tolerance is, their ability to take risk, and what kind of income they need. So it's really kind of playing into, because people for a while were saying, well, hey, the market's going to just keep going up, right? So I just need to get more and more aggressive. Well, no, because we always have these reckoning days, and we always will. And there's two reasons for that. Sometimes it's because people get panicked about things. They don't like change, maybe that's coming through a new administration or a new political opponent or somebody that's new in the White House. Or maybe sometimes it's real structural problems that we need to work through. I had a guy just over the weekend, he emailed me and said, hey, is it time to panic? I said, no, it's not time to panic. I said, but I wouldn't go buy a new yacht right now.
Yeah.
I would wait for a little while. I said, but here's the thing. I said, money and emotion never go well together. And that's not just in the stock market. If you think about all the marketing that we have come at us all the time, Jeff, what are they doing? They're appealing to our emotion,
right,
not our logic, right?
Exactly.
It's not, well, they try to throw a little logic in there. Just think how great you will feel when you get back after you've spent $20,000 on your vacation.
Yeah, right. Well, I don't think it's ever a good time to panic about anything. You've got to have some sort of a strategy or basically take things in stride. But market dips are really nothing new. We had them during the Great Recession. We had them during COVID-19. So if you're nervous about your retirement fund, like the state of your 401k, your other investments, do not panic. So I think the whole gist of this conversation is that this too shall pass, right?
Absolutely, it will. And just as sure as we're sitting here talking today, it will pass. Generally speaking, we've been tracking this thing pretty closely since Jake, like 1895 or something, but we've been tracking the market really pretty much. We've always had ups, we've always had downs, but definitely the trend is up, 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 even since 80, 84, we're up 6,000% or something. It's just a crazy number.
Yeah, I think also that if you do not have a plan at this point, and you are less than 5 years from retirement, this would be a really good time to start looking for that plan, because this thing could get very interesting here. It's anybody's guess. Well, I do think it's definitely higher a couple of years from now. It could be higher a couple of months from now, and it may not be too. And so you need to have a plan that works in all kinds of financial weather. And putting everything in the market and hoping for the best, as people have realized the hard way over the last 6-7 weeks, is not a plan. You're just kind of gambling that it's going to be high when you need it to be high. And so certainly if you're within 2 years of retirement, we definitely should talk and figure out what the best way to help mitigate maybe some of the damage, but also just make sure this money is here for you whenever you need it to take income from.
And for those people who are listening to us this morning, they do not have a plan. Our telephone number, 417-889-7233. We'd love the opportunity to sit down and talk with you, find out what your goals and your wishes, your dreams for retirement are, to design a plan that will get you there and through these turbulent times. Once again, 417-889-7233. No cost, no obligation for this. There's absolutely no judgment. When you call that number, leave your name and telephone number. Ashley will call you back and set up a time for you to talk with Randy and Jake. Even if you got a plan from someplace else, let's go ahead and take a look at that and see whether or not it is meeting your needs and your goals. 417-889-7233. Before we wrap up this particular segment of the show, Randy, you talked about some safer tools and some buffers and so forth that would mitigate the ups and downs in the stock market. Can you be a little bit more specific about some of the things that you might use in this situation?
Yeah, so Jeff, when you look at all the different asset classes that are out there, and some of these we use quite regularly, some we don't use. So you got things like commodities, you got real estate, you got two levels of bonds, you got corporate bonds, you got muni bonds, you got annuity contracts that can sometimes work. Sometimes there's even life insurance contracts that can work for people that have had them for a long time. Of course, the stock market. And so there's just so many different asset classes. They all have different amounts of risk and volatility tied to them. When we sit down with people, there's all kinds of things out there to use, but the thing we need to do is really meet with people, see what's important to them, see where they are, see how much income they need, see how much money they've saved, what their appetite for risk is or what their appetite might not be for risk. I talked to a lady yesterday and she says, I just can't ever stand to see anything ever go backwards. So that type of person versus the one that says, I've been investing in the market for the last 25 years and I've seen it go high, I've seen it go low. Those people have more capacity for risk than the first lady I talked to. Neither one is right or wrong. It's just how people feel. And part of our job as an advisor here is to meet people where they are and help them to maximize their income and growth at a risk level and a risk tolerance that's commensurate with them and how they feel.
Talking with Randy, Jake Floyd, Floyd Financial Group. Once again, our telephone number, 417-889-7233. If you're worried about the market, if you're asking yourself, should I buy this dip? Well, we've got the answers for you that would apply to your individual situation, but we've got to talk to you first. 417-889-7233, no cost and no obligation for that particular conversation. Also, there is no judgment. We'll meet you where you are. Randy, Jake, time to take a break. When we come back here on Show Me the Money, we'll be talking about the fact that 2/3 of investors are worried that they'll outlive their assets. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about, Jeff, there's 2/3 of Americans that are afraid they might outlive their savings.
That's right, and this was interesting, Randy. I didn't think that the number would be that high. It was Global Atlantic's Retirement Outlook Survey that said that their study that they did based on responses from more than 1,000 individuals, they were between 55 and 75. They had $250,000 up in investable assets, putting them within the mass affluent and high net worth bands of wealth spectrum, found that 2/3 of investors are worried that their retirement income may not last their lifetime. And among them, 3 in 10 say they're extremely or very concerned. Randy, are you seeing that in your practice too, that no matter how much money you have, that everybody, even above death, I think, is worried about running out of money?
Yeah, it's one of those things where most people that have money, they didn't just wake up one day and it was there. They amassed it over time. And so I remember looking back over my shoulder in the late 70s and early 80s, we had high interest rates, we had recession, we had high unemployment. But guess what, Jeff? I didn't even know it.
Me neither.
I was so busy working, trying to make a living that I didn't really know that was even happening, right?
Right.
I think a lot of this happens with people. Now, yes, people are probably more aware today because we're in the information age more than we were in 1980, which, seems like yesterday, but I'm kind of dating myself when I
It was like
when I look
40
back there now,
44
right?
decades ago.
Careful now. So what happens is we go out, we go to work, we put our head down, we put money into our 401k, we save money, and we have some market ups and downs, but we continue and stay the course. And then we wake up one day and we have this money, and we've been living off of the income that we were deriving from work. And then we get to retirement and we go, okay. And my sister is a good example of this. She retired now about 15 years ago, and she said to me, I'm on a fixed income. What am I going to do now? And her fixed income was a pretty good one. But, all of a sudden, we're relying now upon something that we're not familiar with to produce the income that we're going to need looking forward. And so with all of the news and all of the positive, the negative, and everything in between, it's important that people have some body that they can go to and sit down and actually get, like right now, what I've been doing a lot of is just sitting down with people saying, this is why we built this portfolio this way, and this is how it's reacting, and this is why we did this, so that you can go home and you can live your retirement life, do the things that you want to do, and know that we're watching, we're monitoring the situation. If we need to change things, we'll do that. We'll also be in contact with you if certain things happen that you didn't anticipate, but we also have regular review schedules now with everybody so that everybody's on the same page and nobody gets blindsided. And it really takes a lot of the fear and anxiety out of this. And the thing we're talking about here, fearing running out of money. The other thing is we coach people on how much is a reasonable amount of money that you can withdraw from your portfolio. You can read lots of stuff on the internet. Some of it's true, some of it's not. Some of it shows a much lower number than I think is possible, and some will say it's a much higher number than I think is possible. I think the most important thing is to have a plan, to have a continual conversation between you and your advisor, and work to plan together and know that plans are not going to stay the same. They're going to change as asset classes come in and out of favor.
Jake, do you think that people are particularly overly concerned because of media overload? I mean, they're seeing all these things about Social Security could be in danger. Healthcare costs are skyrocketing. That in addition to not having a plan. I mean, if you've got a plan, does it still eliminate the fact that Social Security could be in trouble?
I think that, yes, people are probably watching too much media. I would also say, though, that congressional Democrats are largely to blame for the misconception that Social Security is getting cut or anything like that. They are shouting from the rooftops that Trump is gutting Social Security. And in reality, there is not one single instance of anything even close to that happening. But if they say it enough and people watch the news enough, then people start to believe it. And so I actually get asked all the time in my meetings, is Trump really going to cut Social Security? No, he's not cutting Social Security. He said he wasn't going to cut it. He's not going to cut Social Security. He's not going to cut Medicare. He's not going to cut Medicaid. He's going to get rid of fraud where we have 120-year-old people on Social Security and that kind of thing. But he's not cutting people who are taking Social Security. So I think, yes, the media is a serious problem right now. And ultimately, a lot of my clients are pretty conservative, as you might imagine. And I think a lot of people are willing to give Trump some latitude here, given that they elected him to do this. And while it may be painful in the short term, I think there's a lot of people, if you're thinking about this from a common sense standpoint, that know that after we lean out and make our government more efficient and less wasteful, that will pay dividends for 20 and 30 years to come. The same way that when Reagan got in 1980, he had to come in and crack some eggs. A lot of people hated him for it. I think in today's world, a lot of people remember Reagan very favorably. Right. But at the time, there was a lot. I mean, they tried to kill him, frankly, and almost did. I think that there's a lot of similarities between what Trump is doing now and what Reagan did in the 80s. For anybody who's a student of history in the market, you know that from 1981 to like 1997, the market was up 800, 1,000%. I'm not saying necessarily that's what's around the corner here, but I do definitely think that good times are ahead. We need to remain calm and don't panic.
You know, attitudes about annuities are changing too. That is one of the ways that you can avoid running out of money. I think annuities, and correct me if I'm wrong, are they now more in favor than they ever have been before?
I know this, there is more sales of a certain type of annuity than ever before. Variable annuities, for the most part, a lot of those have fallen by the wayside. And the reason they did is they had really no guarantees of principal on there, and they were as volatile as the market. and then they were like 4 times as expensive as owning a mutual fund.
Yeah, variable annuities are like a tariff for your retirement accounts.
It's a good way to put it.
That's true. That's exactly what it was. It was a VAT tax, right? So anyway, in today's world, there's newer annuity contracts called RILAs, which stands for Registered Index Linked Annuity, and then there's these things called Fixed Indexed Annuities. So the RILAs give us some really good downside protection, maybe as much as 20%, while giving us lots of upside if the market does well. And then the Fixed Indexed Annuities give us complete downside protection and give us a significant amount of upside of the S&P 500. I would say at this point, the lion's share of it can be obtained through that scenario. So yeah, there's a lot more flexibility there. Not all of your money belongs in an annuity contract, because we're going to look at some other investments here a little bit later and talk about the liquidity features, the growth features, the safety features, and all that later in the program. But yeah, there's a lot more annuity business out there. I think that's partially due to the fact that things happen so much faster than they ever did. And again, it's because we're in the information age when everybody's watching. If somebody in power in Indonesia hiccups, we know about it in about 5 seconds. So it just makes everything so much faster.
Talking about running out of money in retirement, that's a big fear among a lot of people with Randy and Jake Floyd, Floyd Financial Group. Again, our telephone number, if you'd like to talk about that, your individual situation, 417-889-7233, 417-889-7233. Have you guys ever seen anybody who actually has run out of money? And if you have, what was the reason that they ran out of money?
We've had a few people that have done it, and generally it's for 2 reasons. Either they didn't have an advisor they would listen to, or they didn't have an advisor at all. Now, I'm not saying that everybody that doesn't have an advisor is going to run out of money. All I'm saying is there's a lot of things to watch, a lot of things to know, and a lot of pitfalls to avoid. It's kind of like if you were going to run a race and you knew there were potholes in the road ahead, would you want to know about those potholes?
Well, yeah, of course
you
I
probably
would.
Right? So, that's kind of the deal, is sometimes we don't know, and it's not people's fault. It's just that, we don't do a good job of educating in this country, really, as far as finance goes. But there's a lot of questions they don't even know to ask, and a lot of things they don't know to look out for.
I would say, though, that, again, there's only been, that I can think of, maybe 3 or 4 people that we've had under our management in the last 18 years that I've been here. And 100% of those people were spending way too much money for the amount of money they had saved. That's really probably the main reason that people run out of money, is if you have, let's say you have $1 million saved and you're taking $50,000 a year out, you're going to be fine. If you're taking $150,000 a year out, it doesn't take a genius to understand that that's 6.7 years of income. The market better be ripping if it's going to keep up with that. And there will be short periods of time where the market might keep up with it. But long term, if you're taking a responsible amount of money, 4, 5, 6% off your investments, you're going to have a hard time outliving it, assuming you have somebody kind of keeping an eye on the ship.
Right.
So overspending could be one of the reasons why people run out of money. Their eyes light up when they see these TV commercials for these cars, and, it says starting at $78,000, $100,000. They go to the car dealer can finance me for that. It must mean that I can afford it. Not necessarily the case. A lot of people really do not have a budget. Would you suggest that everyone have some sort of a budget or a bumper plan to avoid running out of money, to really give themselves a reality check?
Yeah, when people come in to see us, one of the first things we do is a complete assessment, of their situation. Most of us, as we get close to retirement, we raised our kids, we paid off our college debt, the kids' college debt, we own our house, and maybe we have a car payment or 2. But for the most part, we're out of debt. We're making more money we've ever made in our lives because we got 25, 30, 35, 40 years time and grade in our career, and we haven't needed a budget. But it's important as you enter retirement to really understand what it is you're spending now, and then also think about, what is my baseline? What does it cost to keep the lights on, to keep me fed and keep clothes on my back, keep my insurance paid up, my car, my house?
Yeah.
And then separate to that, what do I want to do in retirement, and what's that going to cost me? So there's a couple of numbers that factor into that budget. The other thing is, when we're looking at that budget, sometimes people say, well, man, I don't have enough money and I could never save enough money to equal the income that I am now making at my job. Well, here's the thing to remember. You probably don't need to make what you're making from your job, because you'll be funding less in taxes like Medicare, Medicaid. You won't be paying Social Security tax when you're in retirement anymore. And also, we need to think about if we're really funding a retirement plan, we won't be probably funding that anymore either, because it'll be time to start withdrawing from those funds. So the budget in working years versus retirement can look much, much different. And generally, you might even fall into a lower state and federal tax bracket. So just need to have a good plan, a good, well thought out plan, know what the budget is, and that'll help start you on a good track. And then through monitoring and tweaking the plan as we go along and having our regular meetings, you won't get caught off guard. You'll get really settled in and get comfortable with your retirement life.
Well, according to this survey that I'm talking about here that we've discussed in this part of our program, Randy and Jake, only 57% of investors reported having a well-defined retirement income plan. So if you do not have a plan, you would like a plan, or you've got a plan, you want a second look at that, give us a call here at Floyd Financial Group, 417-889-7233. Make that call today. Leave your name, telephone number. Ashley will call you back during the week and set up a time for you to come in and sit down with Randy or Jake. You can do it by phone if you want. But go ahead and make that call right now at 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Randy and Jake, time for another break. When we come back here on Show Me the Money, we're going to be doing a side-by-side comparison of 6 different investment types and how they rate across growth, liquidity, cash flow, safety, and tax savings. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about investment alternatives, and we'll do some side-by-side comparisons based on some factors that we look at as we choose investments for people's portfolio.
That's right. There are about 5 things that money can do for you. They include cash flow, security, growth, liquidity, and tax savings. Now, we would love to have an investment that does all 5 of those, but we found out in reality there is no investment that can give you all of those. There are really almost no investments. I don't think there are any investments that can give you 4 of those. There are few investments that can give you 3 of those. There are probably a fair number that can give you 2. And of course, if you want just one of those, there's bound to be an investment that's going to fit that bill. So let's start off with talking about stocks and how they fare in terms of growth, liquidity, cash flow, safety, and tax savings. So, okay, let's kick it off with stocks here.
So we're going to rate these based on 5 being good, 1 being the worst as we categorize these things. So the good news about stocks, Jeff, has always been, as a rule, it's a way for us to go out and have some great growth potential. Stocks are great, and we know this over the long term, at growing your money. Now, when it comes to liquidity, unless you're out here trading often, and this happens sometimes, people go out looking for great growth opportunities, and they get off into an area of stock where it's not traded with high velocity, and sometimes they can get hung, and it's not quite as liquid as you'd like. But if you stay with the main stuff, the S&P 500 and stocks that are inside there, you're going to have great liquidity. You can liquidate really quick and really easy. Cash flow, it depends on if you're looking at older stocks that are more dividend payers, or if you're looking at a growth company and somebody that's going to give you rapid growth, you're probably not going to get much cash flow out of there without selling the stock to realize the gain. From a safety perspective, stocks can be, well, as we know here of late, a little up and down sometimes. Tax savings, that's one that's kind of interesting. If you have a growth stock and you buy it and you hold it and you don't sell it, you can defer the tax until you realize the gain. But as far as dividend payers, you're going to pay tax current each year on that for tax savings. I would say this: growth on stocks is a 5, liquidity is a 4, cash flow, depending on if you're growth or dividend based, probably a 2. Safety, definitely a 2. If you're not one that can stand your money going up and down, 100% stock portfolio is probably not for you. And then from tax perspective, we'll give it a 2 as well.
Okay, so growth and liquidity, those are the 2 strong suits of stocks. Would you say that stocks might be a better option for somebody a little bit younger in life because they're not looking for as much safety, where stocks score a 2?
Yeah, I would agree. If you have a time horizon ahead of you, that's several years to many years, the market is going to give you the greatest return on your investment and the best outcome when you get close to retirement.
Okay, so growth and liquidity, the two strong suits for stocks. Let's move on to bonds.
So a lot of people may not be aware of this. When you own a stock, you own equity in a company. When you own a bond, you own the debt of a company. And people go, why would I want to own the debt of a company? Well, basically what it amounts to is companies go out, they borrow money. You may remember this, Jeff. A lot of people on here will, because this is something that used to happen. It doesn't happen anymore too much. Used to be when Ford and General Motors would get ready to do their model changeover. Used to be new cars came out in September. You may remember that, right?
Absolutely.
And so every August, in fact, the Ford plant and stuff would close down in July because they knew they had to retool to be ready to go in September. And so GM and Ford would go out and buy they would sell short-term bonds to get money to retool and pay interest on that and then pay them off quickly. Is what they would do. So bonds are the debt of a company, and what they're designed to do is to pay you an interest income for money that you've loaned to a company. So from a growth perspective, bonds are not as strong as stock, probably a 2. From a liquidity standpoint, if you're trading in good credit-rated bonds, you're generally pretty liquid. Probably give it a 4 on there. Cash flow, they're really good because they're going to kick out the dividend if it's monthly, quarterly, 6 months. Just depending on what bond it is, they have different time frames that they pay. Cash flow, they're pretty solid. We'll give them a 4. Safety, if you stay with a good, reputable company, you're not going to have much chance of losing your money. And probably a 3 on the taxation of it. Of course, if you look at municipal bonds and things of that nature, you probably can give it a 5 because you get to kick some of the taxation down the road on that. However, I will tell you that municipal bonds do still go into factoring what you're going to pay as far as tax on Social Security.
So bonds are strong in liquidity, cash flow, and safety, not so much as far as growth. Let's move on to the old stalwart, and that would be cash equivalents. How do they rate?
So, it's been said that cash is king, and it certainly is, because if you don't have any, you can't buy much.
No.
But, so it's one of those things where, is it going to grow much? No, probably not, because, I remember back when passbook savings, and a lot of people go, what's that? Passbook savings.
I remember.
A little booklet.
Yeah.
With a little booklet, and the bank would write in there what you started with. You go back and you'd check your interest. And they used to, back in the day when I was doing that, we got pretty good interest rates. Today, passbook savings is not even a thing anymore, but interest rates are going to vary depending on what the Federal Reserve is doing. Right now, cash and cash equivalents in some cases, like money market funds, CDs, can be pretty good. From a liquidity standpoint, they're very liquid. They're a 2 probably in the cash flow. You don't go to your CD pays whatever it is. If it's a 6 month or a year, it pays its interest at the end. You don't get to take it along the way. From a safety perspective, they're backed up by the FDIC, Federal Deposits Insurance Company or Corporation. And then finally, from taxes, you're going to be tax current on those each year, so I'd give it a 1 on tax efficiency.
Okay, so liquidity and safety are the two main strengths of cash. Of course, tax savings is going to be a 1, growth is going to be a 1. But I think if you're a little older, and you're really concerned with safety, that cash equivalents might be the way to go there. Let's move on to annuities. A lot of people, are confused about annuities. Let's talk about those in these 5 parameters that we're talking about today.
Sure thing. So let's talk about what an annuity actually is. An annuity is a contract between you and an insurance company. Now, when we think of annuities, a lot of people think of the type of annuity that scares most people. And that is, well, if I take the annuity like a pension, when I die, my family gets nothing. Wrong. That is a type, but that's generally used to pay out pension proceeds. And you always have more options than just you getting paid. You have the ability to let that flow to your spouse, and in some cases, even to your children through some of the school pension programs and that sort of thing. But here's what I would say. On annuities, we get a little bit of muted growth, but we also have a lot of safety involved in annuities. Probably not a 5, but probably close to a 4. From a cash flow perspective, we can get regular cash flow that will not be interrupted, and if we want to and we want to pay for it, we can even get guaranteed income for the rest of our lives and our spouse's life. Tax deferral, all annuity contracts, we can tax defer as long as we want to, unless it's immediate annuity where we start taking payments immediately. So I would say from a growth perspective, annuities are probably, in today's world, a 2 or a 3. Liquidity, because we have certain amounts of time we have to tie money up into annuity contracts. And anytime you're looking for safety, you have to give up something. And so we sell away a little of the upside and some of the liquidity to get the safety and the guaranteed income from the annuity contract. So I'd give it a 4 in cash flow, 4 in safety, and a 4 in the tax category as well for tax deferral.
So where annuities fall a little bit short is going to be under the categories of growth and liquidity. They were a 2 and a 1. Let's move on now to ETFs or exchange-traded funds. I'm seeing a couple of 5s here. I'm interested to see whether or not you agree with this.
Yeah, so ETFs, really, when you think of those, now an ETF it's called an exchange-traded fund. It can have bonds in it, it can have stocks, it can have a combination of those two. So let's think of it from two perspectives. Number one, let's look at it how most ETFs, I think, are used today, and that's going to be for the stock market. So we're going to be a 5 for growth, we're going to be a 5 for liquidity, and really we're more liquid than a mutual fund because mutual funds, when I sell a mutual fund at 9 o'clock in the morning, I get the same price as everybody else at 4 o'clock, whereas the ETFs trade on the open market right now in the moment. So sometimes that can be very critical, especially if we look over our shoulder here. The last few weeks where a day was 4 and 5%, I'd like to have a little more flexibility than waiting until the end of the day to get my money. So ETFs can be more efficient. So they're going to be liquid like stocks. They're going to have the growth potential of stocks. Cash flow, they're going to be as good as stock and sometimes better. Safety, just probably equivalent there. But one thing we do get with ETFs is we get some tax efficiency. I'll never forget a few years back, this guy had a Pioneer fund he had had for a very long time and had a lot of money in there. And all of a sudden, he got a $60,000 capital gain. And he said, but I didn't want to sell any of that. I said, well, when you have a mutual fund, the mutual fund manager tells you when you're going to take the capital gain. The ETF, we have the ability to control when we buy, when we sell, and therefore we can control capital gain and taxation. So I would give them, probably a 4 in that area on the ETFs. So ETFs are just a great, low-cost, efficient way to buy groupings, if you will, of stocks or bonds rather than going and buying individual ones.
And they're pretty strong across the board. The strong suits are going to be in growth and liquidity. Finally, we're going to talk about passive real estate. First of all, what would be considered passive real estate?
So when I think of passive real estate, it's not that I own a rental down the street, because if the water goes out or if the roof leaks, I'm going to have to go down and fix it, right? So passive real estate is more something like a real estate investment trust, a REIT for short, maybe some of these Delaware statutory trust type things, but it's where somebody else manages and takes care of that thing day to day, so you don't have to. You're just there to put your money in and collect the dividend, if you will. So as we talk about that, REITs back in the 70s and 80s, and you may remember this, Jeff, when we were building hospitals, we were building malls and vacation resorts and all that stuff. In fact, one of the big REITs early on was a company called Inland out of Chicago. And, they went for like 20 years and didn't have anything negative happen to any of their properties, and everybody loved it. But we were building America through the 80s and the 90s. I would say this, that real estate investment trusts, you have to be careful what you buy today, but let's just suffice it to say that from a cash flow perspective, they can work pretty well. From a liquidity standpoint, not so much unless you're buying publicly traded real estate investment trusts. Most, though, are privately held, and if you want to get out of there, you're going to find the next buyer, especially if it's a limited partnership, you're going to find the next buyer. But you have some secondary options on some of these. But when you go to the secondary market and try to liquidate a real estate investment trust, it's not going to be a pretty picture. You're going to get half, maybe, and it could be less than that. So I would just say this. Do they have a place? Potentially. Do we love them? No. So from a growth perspective, I would give them probably a 2. From a liquidity perspective, I'd give them a 1. From cash flow, will they pay you each month? Yeah, so you can probably give them a 4 there. Safety, 2. Okay. And as far as taxation goes, depending on what it is, you do get depreciation, especially sometimes in the very first few years, you get a lot of accelerated depreciation. So if you've had a big windfall where you've made a lot of money and you're looking for some tax savings on things, this could be a way to help mitigate some taxation on the front end.
I'd say a 3 on tax savings.
Yeah, I'd say a 3.
So in summary, tops for growth would be stocks and ETFs. Top for liquidity would be cash equivalents and ETFs. Tops for cash flow would be bonds, annuities, passive real estate. For safety, cash equivalents, bonds and annuities. And tops for tax savings would be passive real estate, annuities, and bonds, muni bonds. If you have questions about anything that we talked about, you want to get in and sit down with Randy and Jake, talk about your individual situation and what investments might fit into your portfolio. 417-889-7233 is our telephone number. No cost, no obligation for this consultation. And obviously, there is no judgment. We'll meet you where you are. 417-889-7233. Make that call this weekend. Leave your name, telephone number. Ashley will call you back during the week and set up a time for you to come in and sit down and talk with Jake and or Randy on an individual basis. No cost, no obligation, no judgment. You can also find out more about us online at FloydFinancialGroup.com. Randy and Jake, time for a break. We come back here on Show Me the Money. We'll be talking about a late start investment plan and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to talk about, Jeff, what if I get a late start on my retirement?
That's right. If you're starting in your 50s or maybe even 60s because you just couldn't start earlier than that, we want you to know that it is never too late. It is absolutely possible to catch up, especially if you have income and you have a plan. So let's talk about that, Randy. Let's say even starting in your middle to late 60s, you've got time to grow a meaningful nest egg. For the most part. I mean, a lot of people these days, especially men, will live in their middle 80s. That's what my history is. So you've got yourself a good 15, 20 years. There's a lot you can do in that period of time, right?
There is a lot that you can do in that period of time for sure. The thing I would say too is, generally speaking, by the time you get to that point in your career, you're probably making the most money that you've ever made, right? So you probably have a budget where you can start to save some money. And even if it's a small amount to start with until you get a feel for it. And I've seen this happen with people to where it almost becomes a game that they love to play. And that is, well, let's see how much money I can save this month. You know, it's kind of how it goes. And one of the things that happens too with people, I have people, even in retirement, they're pulling money out of their retirement accounts and saving it. And I've told them, I said, listen, we don't need to do that. We don't need to pay taxes needlessly on money we're not going to spend, right? But it's one of those things that once you kind of get into the habit, it's something that you can do. And even a small amount, like I said, $500 a month is certainly a good place to start.
Okay, so if we invest $500 a month and we invest it in something like an ETF or like S&P 500 total market funds for steady low-cost growth, you can end up with a considerable amount of money over 10 years. Let's say that you were able to save as much as $1,500 a month and you invested it for 10 years. What sort of figure would you have at the end of 10 years, figuring an average return, or I don't know, 6 to 8%? Would that be considered an average return?
Yeah, so I mean, I think that's very doable for sure to attain that. So let's say at 6%, it's $230,000. Now we have a sizable nest egg that we can start to draw a pretty good amount of money off of. We can draw probably $1,000 a month off that pretty easily and sustain it and maybe even grow it depending on what's going on. But again, you're going to have that nest egg then to rely upon in case you have something catastrophic come along where you need some extra money. I mean, again, you can pull $1,000 a month out of there ongoing and you'll never outlive it. And if you're spending that $1,000 a month, you may not spend it down at all over the rest of your lifetime.
Okay, so let's say that someone listening to us is age 55. They invest $1,500 a month till they're 65. 6 to 8% return. Again, you can have between $230,000 and $275,000. That is not bad at all. Next one is using catch-up contributions. First of all, what are catch-up contributions?
Yeah, so, all along since the 401k came into place and the IRA, I remember back when the IRA maximum you could put in per year was $2,000, Jeff.
I remember.
And of course, now if you're over 50, it's $8,000.
Mm-hmm.
And so it's one of those things that changes every year. But for the youngsters, those below 50, they don't get to put quite as much in. So the catch up, the extra $7,500 a year you can do for your 401k and the extra $1,000 you can do in your traditional IRA helps you to stock away some more money, mitigate taxes potentially right now while you're doing that, and let the government fund more of your retirement.
So use those catch-up contributions next one if you have delayed saving for retirement. As we've said, it's never too late to save for retirement. Delay Social Security if possible. How much of an impact could that have?
So, each year that you delay after your full retirement age, and, there's just a very few people out there that are 66 and change now. Almost everybody is going to be 67 soon.
Right.
So we'll have 3 years where we will get an 8% simple interest added to that. So just to spell that out, let's say your benefit at age 70 is going to be $3,000. Well, 8% of $3,000 is $240. So between 67 and 68, they'd add $240 a month to your payment. Then from 68 to 69, they'd add $240. And then for that third year, they would do the same thing. So basically, you would be looking at 24% more money by delaying those last 3 years if that's something that you can and are willing to do. And that's a permanent raise that you get right on through until you pass.
Right. So if you can avoid taking Social Security, wait until age 70 to do that. If you're still working, certainly, and you can get by without it, it would be a good idea if you're late on saving for retirement to delay Social Security until age 70. The next one I think is pretty obvious. I mean, if I'm 55, 60 years of age, I haven't saved much for retirement. The basic thing I want to do is control expenses and avoid debt. The less you spend, the less you need.
Yeah, for sure. It's one of those things where you have to really start to think about, okay, do I need a new car, or do I need to trade that car? How do I keep my housing affordable? How do I keep my utility bills and things down at that point in time? And like you said, avoid debt at all costs. Don't get sucked into the Amazon downward spiral.
Yeah. You can buy a car on Amazon. Did you know that? I think it's the Hyundai.
You can buy anything on Amazon.
You can. You can buy a Hyundai on there. Amazing. But I would agree with you completely. A lot of people, get into their 50s and their 60s, and they're starry-eyed about these TV ads. I see them all the time about the brand new this or that or whatever. And when you look at it, I mean, the prices are 60, 70, 80. It's not hard to spend $90,000 on a car. And I think if you're up there in age, you got to think about that. You
Right.
can afford it if you finance it for 72 months, or now they have financing, I guess, 80 months or so, but that's a long way to go for a car.
And this kind of goes back to what we talked about earlier. When you're in your last 5 or so years before retirement, it's when it's really important to have a plan and map this stuff out so that you can say, okay, this may be the last car that I will actually buy, or this may be my last big expense on a car, or whatever it may be. Maybe it's to remodel the house, or to change something in the house, or to make it more friendly for as we age and we can't get around, and maybe we need a wheelchair or a walker, or whatever that may look like. But it's important to have a plan looking forward as to how this is going to come out. So again, very important just to have a plan and think it through. And, anytime you're wanting to go anywhere, any destination, takes a plan. My wife and I are getting ready to take a little trip. We're going to go from Springfield to Myrtle Beach to Aiken, South Carolina, to someplace in Wisconsin near Cleveland, and then up to Detroit to go walleye fishing in believe it or not, the Detroit River.
I'm surprised. Okay, well, I guess things have changed a little bit. I remember catching walleye and northern pike and muskies and things like that as a kid, too. So I hope you and Lisa have a good time. I think a big key here, if someone is planning on taking a trip like that and they're a little late to the investing party, is to try to cash flow those things if at all possible.
Sure.
Eliminate high interest debt, especially credit cards. These days, it's really very common to have credit card interest rates at 28, 29%. I mean, go ahead and use it if it's for convenience purposes, but be sure to be able to pay those off at the end of the month. So control expenses and avoid debt and have a budget. Next one, save for retirement. May not be popular, but keep working, even if it's going to be part-time.
Yeah, I have a lot of folks that plan to work part-time after they start Social Security and retire because, again, depending on your situation, what your health is, if you're married, if you're single, you can only watch so much TV. You can only watch the Yacht Show where the guy is catching the wild boars for so many episodes. So.
I don't think I've seen that one. I'm still stuck on Highway Patrol from 1956, so I'm not caught up. Well, anyway, but keep on working. I mean, that is a very good way to not run out of money and continue to save, because the more money you make, the less money you're going to need for daily expenses. You can add to your savings. It also delays drawing down on your money, and it boosts your Social Security record if applicable. Final one I want to talk about here is getting the right investment mix. So let's talk about that. Too conservative, too risky, and what a good late start portfolio might look like.
Yeah, absolutely. So you're right. We can be way too conservative and not really realize what we could have out of the portfolio. We can be way too risky, come into a time like we're in now, panic, get out at the wrong time, then be too afraid to get back in. So it's really important that you have the plan that is going to both give you growth potential and help you with the risk mitigation, Because again, everybody's a little different, and we have to look at their situation, see what the income requirements are, and based on that, we can build a suitable portfolio that's going to supply the growth that you need, as well as give you the protection against the downside risk.
When it comes to an investment mix, would you say that the 60-40 stock bond portfolio is applicable in this particular situation if you're starting late, or is that ever the way to go?
The 60-40 portfolio was kind of if you look back over our shoulder, the be-all, end-all retirement portfolio for a couple of decades probably. In today's world, I'm not so sure that is exactly where I would be going right now. However, it does hold more water now than it did in the last few years because bond rates were so low for so long. When you've got a 1.5% and a 2% 10-year Treasury bill, what are the chances that interest rates are going to go lower? Now, they happened to back in 2018, but most of the time that means that bond rates are going to go up or interest rates are going to go up. And if they go up, the bond you own gets devalued. Versus now where we got 4 and 5% bond rates, chances are in the future they're going to stay close to the same. It may tick up a little if we have another bout with inflation, but most likely over the long haul, they're going to need to go down, and they're going to go down. And any bond that you own today can appreciate as interest rates go down. So you might get the coupon or the rate that you get, the interest rate off the bond, as well as maybe some price appreciation. And then, of course, if bonds and interest rates are falling and the Fed is generally pushing rates down, that generally is good news for the stock market, which means you're going to get some growth on the other side as well.
So here's the big takeaway from our segment here, our conversation that you've just heard. Even if you're starting late to the investing party, you still have time, you have income, you can create security, peace of mind, and some options. So if you'd like help picking some starter investments, or you would like help with an investment plan or just a retirement plan in general, give us a call here at Floyd Financial Group. We'd love to talk to you, even if you're in your 50s or maybe even in your 60s. Remember, it's never too late. Our telephone number, 417-889-7233. 417-889-7233. No cost, no obligation, no judgment. You can also find out more about us online at FloydFinancialGroup.com. Well, Randy, Jake, we just get started and we run out of time, and that is the case this week. So let's get out of here and make room for the next show. For Randy and Jake, I'm Jeff Shade. Have yourself a great weekend, and thank you for listening to us. Join us again next week for another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.